In this video, we're going to learn about one of my personal favorite financial statements, the balance sheet. I'd like to send a shout out to the Tennessee Council of Cooperatives and thank them for sponsoring this video series. I'm Dr. Justin Gardner with MTSU School of Agribusiness and Agriscience. Let's get rolling. All right, what is a balance sheet? This sounds complicated and scary. No, it's not. A balance sheet's the most straightforward, simple thing you're ever going to see. A balance sheet is nothing more than a summary. It summarizes the financial health of a business at a specific point in time, and it focuses on these three things: assets, liabilities, and equity. If you know how to make a list, you can make a balance sheet. You just have to list assets, liabilities, and equity, and you'll have one. Why is it called a balance sheet? Real simple. A balance sheet has to balance. That's why it's called a balance sheet. The balance sheet is based on this thing called the fundamental accounting identity. Now, something that's called fundamental must be really, really important. That's going to be a test question somewhere down the road. I promise you that. The fundamental accounting identity, it's right there in front of you. Assets are equal to liabilities plus equity. The logic behind that is very simple. Assets represent the things your business has. Liabilities and equity represent who has a legal claim on those things. Liabilities are things you've got to pay out. These are those money you've borrowed to run the business. And the people that you owe that money to, they have a legal claim on your equity. And what they don't have a claim on, you get a claim on. And that is what the equity part of the formula is. Or rather, the people you owe money to have a legal claim on your assets. Right? And the equity portion on the right-hand side of that little equation, that's your personal claim on your assets. A balance sheet, when it's laid out on paper, will have two sides. On the left-hand side, we're going to see our assets all listed, and liabilities and equity are listed on the right-hand side. Now, you're going to see some balance sheets that will list these instead of left side and right side, top of the page, bottom of the page. That's done when you need room. So you can move them around however you need to so that you have room. The main thing is you've got two big categories, two big chunks on our balance sheet. Chunk number one is going to be assets. Chunk number two is going to be broken down into liabilities and equity. And at the bottom of both these sides, or both of these chunks, is going to be a total, because these things are numbers, right? You're going to list a type of asset and a dollar value associated with it. You're going to list a type of liability and the dollar value associated with it. And when you total up the left side and the right side of this balance sheet, or the asset chunk and then the liability and equity chunk, the numbers at the bottom have to be the same. That's what we mean when we say a balance sheet has to balance. So if your assets are not equal to your liabilities plus your equity, then your balance sheet doesn't balance and something's wrong with this formula. All right, let's take a look at assets and talk about them in greater detail. There are two main types of assets we're going to see on balance sheets. Sometimes we might see it broken down into a third category, but typically we see two. Current assets and fixed assets. A current asset is anything you're going to turn into cash during the current accounting period. So stuff you deliberately intend on turning into cash are going to be your current assets. And cash, by the way, is a current asset. Examples of current assets include your inventory, because your plan is to take your inventory and turn the inventory over and magically transform it into cash when you sell it to a customer. It's not magic, it's called doing business, right? And the other thing is called accounts receivable. Accounts receivable is where you've loaned somebody money through your business. Now, you didn't do this in any formal sense like a bank loans money, but it's very common for businesses to have accounts receivable. That's where someone showed up at your place of business and took product out and signed a piece of paper saying they're going to pay you back in 30, 60, or 90 days. Very common for cooperatives to do this because a lot of farmers are not going to have any money until they sell their products, and they need their inputs to make the product. So it's very common for the farmer to show up at the cooperative, sign a bill of sale, and then pay the cooperative when the farmer gets some money from growing their crop or producing their cattle, and turn around and selling it and paying the co-op back. And the plan is to go out and collect those accounts receivable and turn that pile of money people owe you into actual real money. which is far better than imaginary money that someone owes you, right? Because they might not pay you. The other type of asset's a fixed asset. Fixed assets are things that you can depreciate, right? That's cool because depreciation will lower your tax bill, right? So fixed assets, things on the right. Fixed assets are things that you're going to be using long term, like land and buildings and equipment. A lot of businesses will have investments where they've had some extra cash and they stuck it into a savings bond or a mutual fund and they're not planning on doing anything with it. That might pop into a fixed asset depending on the nature of the saving. It could be, if it's just some money in a bank account, it might pop over into the current asset because it is cash, whereas a savings bond that has a time on it or a certificate of deposit that's based on some time period will pop over into the fixed assets. Liabilities. Liabilities means debt. Liabilities is bad news. Liabilities is where you owe people money. Now, just because it's bad news doesn't mean it's a bad thing, because a lot of businesses do owe people money. It's not that big a deal. A liability is not an expense. An accountant would not call a liability and an expense the exact same thing, right? It's money you owe somebody. The outstanding balance on your tractor loan, for example, is a liability. Accounts payable. Very similar to the outstanding balance on your tractor loan. This is where you owe somebody money. We commonly see this happen in a business when we've purchased inventory items and we ordered them and got some paperwork when we ordered it, but haven't paid for it yet. And after we sell it, hopefully we'll have enough money to pay for it. So accounts payable, that's a liability. And any payments you got to make. If someone needs money from you, if you owe them money, it's on this list right here. It's a liability. Just like assets, there are two types. Those types are based on time periods. The first type is current. Current liabilities are liabilities you've got to cut a check for in this accounting period, in this year or week or month or whatever your cooperative's accounting period happens to be. Accounts payable, that's a current liability. This year's payment on a long-term debt. So if you have a tractor loan and you've got to make a payment during this accounting period, then that payment is going to be listed as a current liability, whereas the rest of it, the balance, once you still owe on after you make your payments, goes over to the other side, the long-term liabilities. Accrued taxes. So if you've done business and in the process you've made some money, you have to pay taxes on that money. That's going to be a current liability. Operating loans. It's very common for farmers to take out an operating loan at the beginning of the season to buy their fertilizer and their seed, their diesel fuel, and then at the end of the season have to pay that operating loan back. And so the whole bit of the operating loan, all of it, since you got to pay it all back this year, will pop into the current liability. Now we get to the really good news, my favorite part of the balance sheet, equity. Equity means net worth. Equity is a good thing. You want lots of this. Equity is the difference between your assets and your liabilities. I apologize for the typo on the slide. Typos happen. They're just part of life. If you earn a profit this year, your equity will go up. So earning profit is how you contribute to your equity. Now remember, we're talking about cooperatives here, and this equity eventually will get returned back to our farmers that are members of our cooperative. Profits are going to show up on a document called a profit and loss statement. And when you make a profit, it's going to cause the equity portion of your balance sheet to go up. We sometimes see it called net income or retained earnings. Just as a heads up, you might see that terminology. I do believe this is my last slide on the balance sheet. We'll be moving on next to, I think, the profit and loss statement is going to be our next financial document we're going to cover. So stay tuned for more videos, and thank you for watching.